Hi, I'm Andrew Comstock with Beyond Wealth, and today we're going to go over our fourth quarter review and our 2021 outlook for the markets. So we're recording this on January 7th, and so just want to give you the date on this because we are kind of taking into consideration what's happened this year with the Georgia elections, as well as what happened yesterday in Washington, D.C., is part of our framework for our 2021 outlook. So the first thing I'm going to do is share my screen. And we're going to go through a couple of the numbers from last year. So, the fourth quarter of last year, just like the third quarter, was pretty phenomenal for stocks. What the difference was this time is we actually saw outperformance from small cap companies and the international markets. Both of those have really lagged behind what we like to refer to as the market, and that's generally the S&P 500. Those are the biggest 500 companies in the world. So why did we see some outperformance from the international markets and more specifically smaller companies? The question is, or the answer really comes down to is that we saw a lot of stimulus, and then there's an expectation that we're going to see a recovery in the economy pretty significantly next year. That generally bodes well for smaller companies. And so that's the big reason why we saw small caps outperform in the fourth quarter, is that expectation on future growth next year. You can see though all stock-based asset classes did very well with a 10% or better rate of return. Bonds, again, did not have a great quarter, but they've had a pretty significant rally this year. Looking at the 2020 performance numbers, though, you can see that the green line is going to be the NASDAQ, obviously technology focused, up 44% for the full calendar year of 2020. That's fantastic. Nothing really to complain about there. Now, that's really if you focused only and exclusively almost in technology companies. But the S&P 500 was up around 18%. Small cap companies were up nearly 20%. And you can even see bonds, if you look at the bond aggregate index, was up 7.5%. So considering where we were in March of last year to where we finished the calendar year, it's a pretty remarkable year. Now let's look at those numbers in terms of what happened from those March lows. And we're going to use March 23rd as the date that we picked out. So small companies almost doubled from their March lows. The NASDAQ was up 89%. And then you can see international markets, the Dow and the S&P 500 were, near up over 60% each. Bonds did about 6% off the floor from that. So this is a really staggering intra-year recovery that we saw. And for those investors who stuck it out, stayed with it, stayed mostly fully invested or all the way fully invested, it really was a remarkable recovery. And hopefully you've seen that in your account balances when you kind of look at your year-end statements. So what happened in the fourth quarter to kind of finish off a good year? The two things that we really wanted to focus in on is that we had a lot of uncertainty removed from the market, or we had events happen that we could check off, and they're no longer a concern that what could happen because we now know what the outcome was. The first one was the election. We now know that we are going to have a 50-50 split Senate right now. So that means that technically the Democrats have control of the Senate and the House based on the election outcomes in Georgia. And obviously President Biden has now been confirmed by the Electoral College. And so we are going to have a Democrat tilted Washington, D.C. for the first time in quite a few years. But that is now known, and the markets seem to be pricing all that information in. The other thing is we also have now got vaccines that have been deployed. So that is something that last year we were waiting on. We had expectations that sometime around the election, before the end of the year, that we were going to get them, and we actually got those, and people are now receiving them. So the fact that we've had uncertainty removed on those items is a huge, huge relief for the market. Next up, we talked about technology surging. We're seeing this on a couple of areas. So generally speaking, you saw technology shares have a fantastic 2020, but more specifically in the fourth quarter, we saw a healthy IPO market, or initial public offering. That's where companies go public. And we saw a lot of performance there out of some names like DoorDash, and more specifically Airbnb, just do fantastic. The other phenomenon that we saw really throughout 2020, but came up significantly in the fourth quarter, is what they call SPACs, or special purpose acquisition companies. You're going to be the hit at the cocktail party with that analogy. More or less what these are essentially companies that get created so they can go out and acquire a company down the road. And that bodes well actually for 2021, because there should be some acquisitions that happen from these companies. But that's another thing that's caught investors' attention. Lastly, we had some additional stimulus approved in the waning days of 2020, which helped kind of lift the markets even further. So how are we invested? This is probably the telltale of everything that we do. So we're fully invested right now. We moved into a fully invested status in the fourth quarter. We are overweight stocks right now. Now, the biggest reason we're underweight cash and bonds, just a little bit, and we're only 5% overweight stocks in most of our allocations. So if you're 85% 85-15 is your allocation, 85% stocks, 15 is our target. We're at 90% stocks and 10% bonds, and vice versa if it was 75 or 70-30, 60-40, et cetera. Is mainly we think the expected returns in cash and bonds is really, really low right now. And so we think it's more favorable to be in stocks. We are, however, diversified when it comes to stocks. We are trying to reduce our reliance on growth stocks. Obviously, they've had a fantastic performance in the last year. And so we like kind of being more diversified, focusing on value, low volatility, international. We really think those are going to be a good area for us to get outperformance in 2021. Value and low volatility, we think will do well based on seeing good economic growth and a little bit of inflation. Those tend to be very good environments for those two investment sleeves of the stock world. And we're not overweight growth, as we said about. So, when we kind of shifting to the outlook, is we are optimistic but realistic about what stocks should do next year. So long story short, economic growth is going to be good. We should see, ebbs and flows. It is not going to be a smooth ride with economic growth, but we probably could see 5% GDP growth in the United States over the full year. We expect there to be ups and downs there as a lot of things happen and as the reopening event kind of happens around the country. Corporate earnings are going to be strong. 2020 is a pretty easy hurdle for the earnings in 2021 to jump over because of all the depressed economic activity we had this year. But there is even most people on Wall Street, we do believe as well, is that we should exceed the 2019 earnings, by a fair amount this year, and 2020 should be very easy for us to get ahead of that. So that's a positive thing. The other thing we like is companies right now took advantage of the low interest rates seen throughout this year. Just like a lot of people refinanced their mortgages in 2020, companies went out and borrowed a lot of money because they took advantage of these low interest rates. So they got a lot of cash in their balance sheets. And company management can't help themselves. They can't keep the cash in the bank necessarily. So we expect them to do a lot of things. Primarily go out and acquire or merge with other businesses. That's good for stocks. The other thing we expect to see is a renewed emphasis on share buybacks. Politically, this has been a little bit of a whipping boy, but from our perspective is we expect companies to go out and start to buy back their own shares. And companies always like to buy their shares, not necessarily when they're cheap, when we want them to, but generally as their price is appreciating. And so that's something we expect to have happen significantly in 2021. Another point is the U.S. consumer is in great financial shape. Despite we know that a lot of people are hurting right now financially, the vast majority of Americans are not. And that's what the data shows, is that savings rates are quite high. Credit card balances have been paid off. And now that everybody's getting some stimulus money, with potential for more stimulus money coming with the election results, a vaccine, and pretty much everybody not wanting to do what they did in 2020. So they're looking to take vacations. They're looking to do other things other than maybe do home improvement projects and things around their house. That's a really, really significant catalyst for the economy. Consumer spending is a very important component of it. And the fact that we've got stimulus coming, a lot of cash on the sidelines, and some pent up demand, I think that could be very good for the economy and good for the stock market. Lastly, we've talked about this a lot in the past, so I won't belittle this point, is the Fed is going to be very supportive for the markets, not just for a few months or quarters, but for a few years. They're not planning to raise interest rates from 0% until we get 2% inflation and full employment. Both of those things, inflation could happen quicker than full employment, but that's something to be mindful of. So what are the risk factors? We've laid out a really rosy scenario. It is not going to be a smooth ride, and we are expecting it to be a good year for the markets, but for us to have a third year of double-digit rate of returns like we've seen, we do not expect that to happen. We do expect it to be a good year for the markets, and we'll talk about that here. So right now, if we look at the forward, so the projected earnings for 2021 puts the market at 22.3 times earnings. Historically speaking, it's about 16.5. So you can see we are expensive. There's a lot of reasons why we can justify that and say that it's not a reason to run and hide because we've got an expensive market. Interest rates are low. We know growth rates are going to be quite good going forward. But the peak of the market that we saw in 2000 at the peak of the technology bubble was 27.2. So we're not at all-time highs by any means in terms of valuations. There's some metrics out there that you can look at that point to that, but there's also interest rates were much higher back then as well. So it's never a like-for-like comparison. One thing that a lot of people look at is when you look at PE ratio, it might be a signal that it's a good time to sell. And generally speaking, that's actually not true in the short term. When you look at it, there's not a lot of correlation between where the market's valuation is at and where it happens over the next year. Where we do see some value is over the next 5 years, we expect the average rate of return for stocks to probably be below the historical average by a little bit. That's something that does hold up when you buy things or investing money at kind of a higher expensive multiple. We're not changing our opinion a whole lot on the stock market because of that. We do think that this year is setting up to be a good year, but we're being mindful that we may be pulling forward returns from year 3, 4, 5 potentially. The other thing that we're watching is sentiment right now. So there's price is sentiment or performance is sentiment. So if things are doing well in the short term, people are very optimistic. If things are doing poorly in the short term, people are usually negative. We are in an area where we're probably seeing people reach not quite that euphoric state, but people are very optimistic. And so they're expecting, we may see people continue to pour money into the market, and that's mainly individual investors because the performance has been great and it's been easy along the way. For our belief is we're going to stick to our investment plan. So we're not going to jump investment allocations or get more risky just because the markets have been good. And we're going to kind of hold the line there. We may go overweight, which we have right now, but that's about as extreme of a position as we'll take. And we're going to end on one of our slides that we like to refer to over time here, because I think this is going to be a meaningful thing for 2021. So this is from Standard & Poor's, and I apologize if it's a little fuzzy, but more or less what you can see is the year-to-date returns over the past 30 years for the S&P 500. And then on that red dot is essentially the maximum intra-year sell-off. So how bad things got in that year before we maybe recovered. And you can see it's not uncommon to have a 10% or greater sell-off and still have a good rate of return for the year. We know that things are not going to be smooth in terms of vaccine rollouts, in terms of economic growth, in terms of obviously what happened yesterday in Washington, D.C. There are things that are going to come up and surprise us, and the market is probably going to sell off. There's not a lot of wiggle room in terms of value, let's just put it that way, out there for the market. Things have to go generally pretty smooth. But we're optimistic that we're going to end the year higher. But just be mindful that take this into account is that we probably will see some negative returns during this year, just because that's historically what happens. So wrapping up, Q4 2020, very, very good year. 2020 was a very good year. We are optimistic about 2021, but we're being mindful that returns probably won't be as good as last year. And we are a little nervous that over the next 5 years, that rates of return might be below average, but that does not mean that we expect them to be negative. So please reach out if you've got any questions. We'd love to engage with you guys. But hopefully you like these videos. Please give us any feedback. I'm Andrew Comstock with Beyond Wealth, and have a great day.